choice question, on forwards versus futures. Think of the forward farmer. So a farmer is trading forwards. He's buying and selling them because he wants to lock in a price for his bushels of wheat in the future. So that's forward. Futures, just like we did in class when he showed it on the internet, a future is traded on an exchange. So that might come up with a question. All right, so let's do an example of a forward, because I think this makes it pretty clear. So you got a farmer who's selling, and he's expected he's going to have 100,000 bushels of wheat, right? And whenever the price...
Bushel is like a bundle of, you know...
Yeah, a bushel of wheat it's a bunch of wheat. Who knows? The only thing that matters for us is he's got a lot of wheat, and what is he trying to do for himself personally? So there's a price for a bushel of wheat now, and whatever the price is now, it doesn't matter. He hasn't harvested that wheat, so he knows he's going to harvest the wheat in 1 year. And let's say the price for a bushel of wheat now is arbitrarily $1 per bushel. But we don't know what the price is going to be in the future. So this is the kind of intuition you need to get about what's the farmer trying to do. Is that he needs to know he's going to have a certain level of income at the end of the year so that he can continue to be a farmer. Because he has to buy fertilizer, he has to pay electricity for water and everything. So what he wants to do is lock in his expected price. So what he'll do is he'll go to a bank and he'll lock in the price for the future. And let's say the bank is okay with locking in the price in the future, and this is just completely arbitrary, at $2 a bushel. And let's say this is for 1 year hence. Now mind you, the time frame and the price is all I just made it up. So he knows in 1 year, he's going to get $2 a bushel, so he's going to get, $200,000. That's locked in. And this is the kind of intuition you need to get on what would happen. What if the price in the market for a bushel of wheat is $3? For the farmer, he could have, if he had waited and just took a risk, he could have sold the wheat on the market for $3 a bushel and made a lot more money. For the bank, the price of wheat on the market is $3. They're able to buy it at $2 a bushel. So they're making, a profit of $1 a bushel. But they took that risk, that it would be the same or higher. For the farmer, though, imagine at the end of the year, the price for a bushel of wheat is not $2. Imagine it's only $1.50. He's locked in that price of $2 per bushel. So he gets the security of knowing he at least made that, and the bank loses out. Is everyone cool on that? All right. Let's do is everyone really cool on the part of the stock and buying a stock forward? Yeah. Just the intuition of, here's the stock price now, and why it's got to be what it is in the future. All right. Let's say the stock price now is $25. Right? And this is the example that the professor gave in class, and I think it's pretty straightforward. And you want to buy a forward. So you have a choice. You can get one share for $25, and you can get a forward in the future, where you're allowed to buy that stock in the future at some price. The question is, what is that price going to be today? And this is assuming we're not going to have any dividends at the moment. All right, and we also got a risk-free rate of 6%. So the question then becomes, what should that forward price be? Like, for you to be able to buy that stock in 1 year, if the 1 year risk-free rate is 6%, what does that price of that forward have to be, at least? Right, and it should be pretty obvious that you should be able to, for there to be no arbitrage, you should be able to not take that $25, invest it at 6%, and in 1 year, you'll have that future thing. It should be at least above 6%. And so the value of the forward is going to be 25 times 1.06, which gets us to 26.05. I'm sorry, 26.5. Is everybody cool with that part? No? Okay.
So you're just multiplying every stuff, right? Compound.
Yeah, let's try this. All right, so strategy 1, we're going to buy 1 share for $25. And we're going to sell the share forward in 1 year for the forward price F. And we're going to sell it for price F. So the cash flows, and it'll be clear, I think, when we see the cash flows. The cash flows we get 0 from selling the forward share, minus $25 from buying the share. And in 1 year, these are the cash flows now, and these are the cash flows in 1 year. All right, in 1 year, we're going to get F, whatever we get for the forward. And what we should get for that, and this is the key thing, is that if we're paying $25 now, and you can get at least 6% risk-free rate of return, then the price for F must be 26.5. Right? Because we can take that 25, we can invest it at the risk-free rate and get at least 6%. And so if you see the price for forwards, and this is the key thing, right? If the price for a forward the price for forward that you see is actually being sold for, instead of 26.5 like it should be, let's say it's selling for 27.5. So is that over or underpriced?
Overpriced.
Right. And so if it's overpriced, we can sell the forward, buy the stock now, and we'll make a riskless arbitrage. Because it should be 26.5. Let's say it's not overpriced. Let's say it's selling at $25 flat. Is it under or overpriced?
Underpriced.
Under. So what we can do is we can buy the forward, sell the stock, and again we'll make a riskless arbitrage. Because we know this is what the price has to be. It has to be the value of the stock today plus at least the risk-free rate. Because if it's not, we could just sell the stock with the proceeds that we get. Like the stock is 25 bucks, right? We could sell the stock for 25 bucks, and with that 25 bucks that we get, we could invest it in the risk-free rate and get a 6% rate of return, with no risk. And so at the expiration of the forward, it has to be at least the value of the stock plus the risk-free rate. Is that cool?
Could you
Stop
repeat
there.
that?